Welcome again to the FundSeeder Rise Podcast. Today, I'm honored to be joined by Neil Ramsey, CEO and Chief Investment Officer of RQSI. Neil leads all investment activities at the firm, including trading strategy development, portfolio risk management, and the overall strategic direction. Over his career, Neil has seeded more than 20 portfolio managers who have gone on to collectively manage over $20 billion in peak assets under management. And prior to founding RQSI, Neil was a consultant at the Boston Consulting Group, and he holds an MBA and an engineering degree from Vanderbilt University. So Neil, thank you so much for joining me today on this podcast.
Thank you for having me, Emanuel. Let's see how this goes.
Yeah, well, one of the first questions I had for you is you had somewhat of an unorthodox pathway to the markets and the investment industry. You're a consultant, obviously, as I mentioned, at Boston Consulting Group. You had an engineering degree. What really first drew you into the markets and the investment industry?
It's funny, my first two trades both convinced me that I shouldn't be a trader. So gold had a large move in 83 and 84, and I decided I could trade gold.
Yeah.
No real basis. No analysis. I knew it was going up. I knew a lot of people wanted to own it. Opened an account at Shearson Lehman, put $10,000 in it, and instantly ran it up to $25,000. Of course, that's what's supposed to happen. You're supposed to make money. That's easy. Watched it go back to 15 in a matter of 3 days, 15,000, and said, I don't want to watch it go negative. I'm done. Closed the account and wired my money out. That's the first trade I did. Second trade I did was an option trade in was it United Technologies? They had the Bhopal plant that blew up in India. Stock collapsed. I think it went from like 44 down to 32. I bought 34 calls thinking this is overdone. I think I did it like maybe the low day of the price move, the stock move. I didn't know I did know what implied volatilities were. We studied it in business school, but I didn't know it to trade it.
Yeah.
I bought options with very high implied, not understanding just how much erosion. 34, they were too short dated. Stock over the next 6 months, I think, went back to 42. Of course, I lost money on my options despite having timing correct, point of entry right, but I didn't understand options well enough. And I thought, okay, I'm too dumb to know this also. So that was pretty much my start to trading and my start to markets with no formal training other than option classes in graduate school, and realized I really wasn't meant to be a trader. Didn't really have any interest in finance. So this didn't start from, you hear about these young guys reading the Wall Street Journal when they're 6 years old. And
yeah,
that wasn't me. I mean, I'm naturally curious. I was always curious about the stock market. Oh no, there's a third trade. I forgot that I had a broker at Shearson Lehman, and every year Shearson Lehman issued their top 10 stocks to buy for the year. So I think I put $3,000 into 10 stocks, $30,000. Of course, they had all gone up before I got in. I didn't pay any attention to that. I was obviously the last person that was called in the promote. Watched my 30,000 turn into 24 over about 3 weeks and said, okay, I got duped. I was stupid. So that was my first 3 entrees. Yeah. And
wow.
So I'm sort of both curious and a little skeptical. Wasn't enough of either, but it certainly got my attention on trading is not easy.
Yeah. It's interesting. Most of the trade, or a lot of the traders and the stories you hear about in Jack's Market Wizards, where they start accounts and they make money. Maybe they have the same kind of path that you have, where it's like somehow they got lucky, right? And they make money and they think they're really brilliant at their trading, but then they lose it all. So what intrigued me about what your trades is, there was still an element of actually like risk management, where on that gold trade, you're like, I'm out. Like I'm not going to go this have this go to zero. And there was still almost like this intrinsic, like, I'm not going to lose this money. Why do you think that was the case? Like, I mean, as an inexperienced trader where maybe, greed kicks in or you think you have it, like what made you get out and realize that, you're not prepared for these, for trading at that point?
Sure. Well, the gold trade was really simple. Watching my account go from 10 to 25, I was smart enough to know I was lucky that that was not skill. And to watch it go back to 15 so quickly, I realized I have no idea the risk I'm taking. This thing could go anywhere. And so I've always been aware enough not to think I'm brilliant when I do get lucky. And then it's just, if I can lose money that fast, I can lose it fast again. That was just, I did not want to watch the money go negative.
So it was like almost like this self-awareness that you had that, like, okay, this was just a lucky trade, and if it went up, it could come down. And that's interesting, Neil. We spoke with John McCauley, who's one of those trading psychologists, and he did talk about, self-awareness is a key component to being a successful trader, and it seems that's what you had. So you did those trades, and you closed out the account, and then what happened? Like, how did you come back into the industry and sort of start the evolution of RQSI?
So my father was a real estate developer, and he was a natural risk taker, and he was a good risk taker. I wouldn't say he was not a great student. He was not really that curious, but he did understand to invest in things that he thought he had an edge, he believed in, and he wasn't going to take much loss. But he had invested a small amount of money with some CTAs in 1984, the same
Mm,
time I was in Chicago. And in fact, I guess it's MFA now, but it was MRA back then. One of the first MRA conferences was in Chicago, and I'm going blank in the hotel. But I went to an MRA conference when I was with BCG in Chicago. Didn't know what I was looking for. Didn't know who to talk to, but it was interesting. I was at the Palmer House. Anyways,
Palmer House Hilton.
yes, it was in the basement of that hotel. It was interesting. I met a few people, met some of the traders that were in our portfolio. And then early 85, I moved to Louisville, Kentucky. I was going to work with my father. And he had some eclectic investments. And I took a very large pay cut, but we'd had our first child in Chicago, did not want to raise children in Chicago. Um, like I said, took a large pay cut. I'd always saved my money, so we could live for a long time on what I had saved. My first business venture, I opened a couple video arcades when I was in college, and
Wow.
that was very successful. And again, I thought I was lucky. I did not think I was a good businessman. I hit a craze correctly and got a decent location. But that business was making me a lot of money, and I saved every penny of it. So I had that money, and I'd saved my most of my salary at BCG. Um, Moved to Louisville because that's where we thought it'd be closer to the grandkids would be closer to a set of grandparents, and I was going to clean up non-real estate investments that my dad didn't know what to do with. And he said, "Would you take a look at this CTA portfolio?" And I said, "Sure. What do you want me to do?" He said, "Tell me which ones I should keep and which ones I should close." I said, "Well, it'd be nice to have some information." And of course, back then, you'd have these whatever 50-page disclosure documents, and he had all the disclosure documents. I think there were probably 12 traders. Um, and I read every disclosure document and tried to learn a little bit about what they did. And I looked at the account statements and what type of trades they had on. And yeah, I decided that there were some things that mattered. And I read, um, you know, simple analysis, how much had they made? Let's say they had a 3-year track record.
Yeah.
What was the return and what was their volatility to produce that? So just a simple Sharp ratio, return minus interest rate divided by volatility. So that was my starting point. And then I started looking at how different their backgrounds were. You had PhDs and you had farmers and you had guys that came off the floor. You had self-taught guys that just, liked the markets. And I decided that years of experience mattered. So I came up with about 10 different attributes that I put on the x-axis. into a sort of weighted average score of risk or goodness. And then the y-axis was historical return. And I plotted it all out and took it down, showed my dad, and I said, and I drew a line. I said, I like these guys above the line. I don't like these guys below the line. He said, okay, close those guys. So I don't even have their phone numbers. I don't have a relationship with them. I have nothing. He said,
Yeah.
well, here's the phone numbers. So I started calling people and closing accounts and made contact with everybody. And, I'm not going to, there were a lot of old names back there like Fundamental Futures and Dean Jones and John Henry. Lewis Bacon was in there. Paul Tudor Jones was in there. Cambridge Associates was in there. A lot of the old names. I think Edwin Miller was in there. Elm. A lot of these people aren't even with us anymore. But anyway, I started closing accounts.
Yeah.
And then I looked at where we had the brokerage accounts. And one of the people that helped me the most was we were paying $20 a round turn for commissions. And a friend of mine said, I know Tom Dittmer at Refco. You ought to call Tom. So I just called up Tom Dittmer. And Dittmer was an absolute wonderful person to deal with. I mean, he's got a rough personality, but he was great. He said, well, I'm flying my jet down. You're coming to Chicago, and I want to talk to you about futures. And he cut me a rate for $10 a round turn. Had everything consolidated at Refco. And I went to my dad and I said, Dad, here's the deal. I don't want to be paid, but I can save us $10 a round turn. Why don't you let me keep the $5 and I'm going to hire an accountant to help me track this portfolio and I'm going to start tracking CTAs. So that's how I got into the business. And
Yeah.
at that, it paid for my accountant, the savings and commissions. And then we just continued to look for talent and built the portfolio larger. And it went from being a fairly small part of what we did to as relevant as the real estate portfolio. So that was from 85 to 87. And then in 80, and I can stop talking if you want to interrupt with questions.
No, this is good. Just one question. I mean, I think it'd be interesting when you have that portfolio. You said what, about 12 CTAs?
Yeah, it got up to, by 87, it was up to probably 15, 17.
Yeah. And so the CTAs and the traders themselves that you decided like we're removing from the portfolio, if you can articulate generally like why was it just their returns? Was it the way they were managing risk? Where is it just maybe their experience, as you mentioned earlier, was not to the level of say a Paul Tudor Jones? What were some of the reasons you decided to remove those traders from that initial portfolio?
It was very simplistic and not particularly informed. Mostly return. I was closing guys that hadn't performed well for, 2 years, let's say. Um, I interviewed them all, and this is still a main thing. It goes back to your self-awareness comment. To me, self-awareness is everything. I've also heard it called, I think Jack Welch used to use the term intellectual integrity. In other words, when you say something, do you have the integrity to even know if what you're saying is true? Can you say it to yourself? And I call that self-awareness. But if somebody cannot articulate their edge, why they're likely to make money in the future, it's very unappealing to me. Um, another, you've heard me say it, avoid inexperienced system genius is one of the early things I said. These guys that thought they had done something on a computer that was special, but really didn't understand markets. It's just a data analysis that had nothing to do with the reality of whether or not that anomaly would repeat itself. So, experience matters a lot. Self-awareness, the ability to call your edge and know what your edge is, and it still comes down to performance. So, and it's interesting. Signetti, who everybody's in love with now, the IU football coach,
Yeah.
interviewed on how he selects players, which I thought was really fascinating. And I think he's right. He said, I don't really care about potential. He said, I don't recruit potential. I recruit performance. Give me a Division II player who caught 48 passes last year. I'm interested in him. And at the end of the day, trading is a results game. And it doesn't matter how eloquently you speak. It doesn't matter how strong your presentation is. At the end of the day, do you have real results? And can you explain the nascent what's the essence of those returns? What's your edge? And like little things, can really bother me. And I'm sure you've heard this. A trader tells you, how'd you do today? We were flat. Well, for the trader that was down a little bit that says he was flat, I don't like that personality. That
Yeah.
bothers me.
Yeah.
I guarantee if he was up a little bit, he'd say he had an up day.
Yeah.
If he's down a
Yeah.
little bit, flat. And that's a really minor thing, but I think it speaks to, and you state the truth as it is without trying to embellish it.
Yeah, that's a good point. That's a good point, Neil. And we're going to get into kind of your perspective on evaluating traders a little bit on, but continuing from 87 and 88, because I think that your journey is important. Like after you had this portfolios, what went next? What happened?
Um, that's when I decided to trade again.
Okay.
Uh, I'd been talking to traders pretty much every day for 3 or 4 years, and had some had some really strong mentors, people that were just older, experienced guys. They were just nice to me. I mean, they described why they did what they did. They described the simplicity of a moving average system. They described, we had one good trader out in San Francisco, David Cook, who was a very good reversal trader, and he had certain patterns that he looked at. And he helped me understand how he looked at a chart, how he thought about reversals. There were about 4 or 5 guys that I talked to on a regular basis that,
Can you name, I'm just curious, like some of those mentors that were influential for you?
well, Stan Druckenmiller was one. In fact, I actually bought British pound the day that Soros made all that money being
Wow.
short British pound. And I talked to him that morning. So you might wonder how I could be that stupid. Well, I was that stupid. And all he said to me is I wouldn't do that. So it proved I'm not very smart. But anyway, 88, 87, 88, after talking to these traders, I started building trading models, and very simplistic in Excel. At that point, I think I started on VisiCalc, but then eventually moved it to Excel. Um, but things like a moving average with, RSI divergences where I'd peel off some of the gain, a reversal around highs and lows, and a moving average. Um, and I started showing this to a friend of mine at Salomon Brothers on the FX desk, and we decided we could start a CTA, and we did in '88. Um, and this is probably the most formative thing that's happened to me in the industry. We quickly raised $75 million, which was a lot of money.
A lot of money back then for sure.
And first 2 years, I think we were up 22 and 24%. So we had real incentive fees. Clients were happy. We were smart. The third year, I think, was very solid also. Fourth year, we went straight into a 12% drawdown. And we did not expect 12% drawdown. We expected, 5 and 6% drawdowns, but not 12. And very bold move. I told my partner, we don't know what we're doing. We don't know what our edge is. We had alignment like we'd never seen. So that would have been 92, 93. I can't get my years right, but that's when, PIBOR and LIBOR and every short rate in the world became very highly correlated. You had the same trade on across your portfolio 10 times instead of, everything was unique. And we had alignment we'd never seen, went into this drawdown. We didn't understand how to build a portfolio. Our back testing was extremely limited in terms of capability. And I said, I can't manage client money not being able to say I know exactly how we're taking risk. I'm not saying that we won't lose money. It wasn't the losing money, but it was the fact that we did it in a way that we didn't understand, and we couldn't test it and understand how that was going to happen in the future. We gave all the money back.
Were the investors surprised? I mean, and how did you compare during that time period against, I don't know if they had benchmarks back then, but just your sort of
Yeah,
peer.
we a lot of people were losing money then. We were
Yeah.
losing could have been. Yeah, the clients were surprised. I think they appreciated. I mean, it's not like, they're managed accounts.
Yeah.
Managed accounts, that's one of the problems with building a business around managed accounts. They could have all closed as quickly as we closed the
Yeah.
business. And I thought that's where we were heading anyway. We'd had no account closures yet. But I think people generally respected it. In hindsight, I don't think I would have done it. It's hard to build a base like that. But anyway, I think we're off track a little bit.
Yeah.
But that was very formative for me in terms of I knew I wanted to manage money I did not like running a portfolio of CTAs. I felt like I was too removed from the decision making and the risk taking. So I said, no matter what, over the next year, 2 years, 10 years, whatever, I will be back in asset management, but I'm going to do it right this time.
And what did then after you gave that back, is that when you transitioned to maybe doing a little bit more research and focus and in terms of figuring out the models? What did that next
But
period
during
look?
that time, we continued to allocate to CTAs. That's been continuous since whatever 85.
Yeah.
Um, and I really do enjoy the interaction. I just don't want a whole portfolio dependent on CTAs. Um, so yeah, at that point, I said I, I had watched, I had interviewed almost every type of manager you can imagine in terms of fixed in fixed in arbitrage, merger arbitrage, mortgage arbitrage, um, and I saw a group that did statistical arbitrage. And all the different quote arbitrages I thought looked really scary because there was always a mismatch in liquidity or credit or something that looked like it could get wiped out. But I looked at these track records and I knew a CTA was going to produce, if you were really good, you might get to a 1-0 Sharpe ratio as
Yeah.
a CTA. But I was looking at all these arbitrage strategies, convertible arbitrage, and a lot of them were showing 2 and 2.5 Sharpe ratios and said, I'd much rather build a business around a 2.0 Sharpe ratio than a 1.0 Sharpe ratio. And got very interested in stat arb when I saw what it was because I saw the two legs of the trade had basically the same risk. You're long a whole bunch of liquid stocks and you're short a whole bunch of liquid stocks. And at the end of the day, you're short-term momentum. So you do have one giant factor risk. But that's what a market maker does,
Yeah.
provides liquidity against a momentum. And I looked at it as essentially a market making inventory operation and said, I want to do that. So I missed a step. So after I hired a PhD electrical engineer that could help me model things where I kept building futures models and built some models that I liked. But again, I kept getting to, zero point 0.9 Sharpe ratios and said, I can't build a business around this. And had some, nice trend following models, some reversal models, et cetera. But anyway, in 95, 96, figured out that we can model this stat arb. Scared me because it was a very complex trading strategy. So the strategy really had two legs. You got more than half your alpha from a good trading model, um, whereas your alpha engine, which was the some form of mean reversion, you can use residuals or the spring equation from physics, or there's lots of different ways to do it. But at the end of the day, you're fading short-term momentum, relative momentum.
Yeah.
Really put a lot of time into how to think about the best way to enter the markets as far as executing these trades. I mean, this is a portfolio of we ran a couple $1 billion in this strategy. We were trading $1 billion of stock a day.
Well,
And so it turned into a technology business, sending 100,000 trades a day. So anyway, that was the big conversion. That's where we've had our largest successes in private markets.
yeah.
But in terms of trading, stat arb was really what we did well and pretty much thought it out correctly the whole way through. Knew how to model, knew how to change variables, understood portfolio, understood factor risk, and understood trading.
Yeah. You know, transition now to talk more about you being an early backer of traders and what you looked for traders because, man, as you know, the vision for FundSeeder, FundSeeder is now part of RQSI and it has always been to find those unknown, undiscovered traders and back them, provide them with the mentorship, help them grow and help them scale. Curious, just before we go into some of these early success stories that can be almost a testimony to those who are listening and have aspirations. How has the industry, from your perspective, evolved from when you started allocating to some of these CTAs to where it is today? And what's the main difference that has changed?
Sure. I think the biggest change is who the clients are and how you get to the clients. You take from through the 80s and 90s, there were a lot of introducing brokers and there were Frank Pusateri's, Steve Solomon's, um, big introducing brokers that knew where the money was coming from. And a startup CTA could get seeded and get capital fairly quickly with a decent track record. It's much more institutional now. Um, Finding the type of traders that we're looking for at FundSeeder. I don't know if you'll be talking. I'm sure you will on some of them. We have some very interesting managers in the FundSeeder portfolio, but one of the things I struggle with is I see tremendous talent, but it's sort of hard to figure out how to dress up some of these guys to find the pools of capital that would be interested in. A lot of these guys are 1 and 2 man shops, limited infrastructure. They're not really excited about telling their story to a lot of different clients. It's, to run a business and to talk to clients is a very different business than being enamored and passionate, obsessed with markets. And we're finding a lot of guys that are, have the makings to be very good traders, to make good risk reward decisions and manage, I'll call it our small capital. What have we allocated?
Yeah, of this year, over 100 million.
But across 15 managers,
Yeah.
and and we're seeing some talent. The overall experience is not as good as I'd like yet, but we're seeing real talent. But I still don't know for sure how to dress up the talent and get it to pools of capital that'd be interested in it.
Yeah. Yeah, I think you're
So that's the big thing is that I would have known where to take these people in 1990. It's hard to do.
Yeah. So in the early, in the 1990s, where you did allocate to some of these success stories like QIM, Fort Crable, like, and we talked about, your early, sort of portfolio management of your dad's portfolio, some big household names. At what point did you decide, I'm gonna just start backing some early talent? They didn't have to be the most recognized names, established. And why did you do that? When did that happen? And then if you could tell us some success stories from that journey, that would be helpful for our listeners.
Sure. Um, let's go back to 1990. At the point a manager hit 100, 150 million, he was asking for a 2% management fee and a 20% incentive fee and getting it. Once a manager got known in the community, uh, fees are extremely high. So I didn't like paying 2 and 20 to a manager because I thought it was too much of the gain was being taken, which would hurt my risk reward. And I would interview, call it the managers that had made it versus the up and comers. The up and comers were just as good at traders. And I usually chose low fees, 0 and 10, 0 and 15, 0 and 20, to a stake in the business. I took some stakes in businesses, but generally speaking, if you take a stake in the business, your flexibility for closing the account goes down because you better act like a partner, meaning you're sort of stuck. And I like the idea of seating somebody a low fee, and then I had the freedom and the liquidity to get out if I wanted. Um, like you mentioned Crable. I mean, I didn't seed Crable, but I was in Wisconsin at least 3 days every 2 weeks working with him on automating the systems. And I just loved working with Toby because he was incredibly curious. He wanted to learn. He was obsessed and passionate about the markets. And if he failed, he knew it. He admitted it. You talk about he has lots of self-awareness in trading.
Yeah.
I loved working with him because, we could actually make a difference. We could automate what he was doing. And it was kind of a challenge because he fought being automated. He didn't really want to do it. He thought he could discern trades as they came. I don't think he believes that now. But so that was just a fun challenge. We had good fees, and I thought he was a special trader versus, I don't know who would have been a parallel at that point, but another shorter term trader that would have asked 2 and 20. So I did it because it was more interesting. It was more personal. I could know them. I could understand what was going on with their lives and risk isn't just when you put on a trade. Risk is everything that happens in your life.
Yeah.
Anything that clouds your judgment affects your risk taking.
Yeah.
So in any case, I did it because fees were better and I felt like I could know my risk better. And I actually thought I found better traders.
Yeah. Yeah, that's good. And it's not like a black and white because we've talked about obviously, performance, how it's important and it's key and risk management and but what you mentioned about Crable and his kind of his personality a little bit or his just character, traits, if you will. When you see a
I'm going to
trader,
be careful. I'm going to be careful talking about his personality and his character because he might watch this. So I'm not going to say anything.
okay, all right.
Toby, Toby's great.
Well, how about this? So when you first meet a trader, and you have the performance, but what are some non-negotiable traits that you look for early on when you back a trader? And we talked
Yeah.
about some,
Yeah.
right?
We talked about some of it, but when somebody is extremely secretive about what they do, I won't be on the phone call very long. You don't have to give me anything proprietary to give me the essence of what you do. If you don't understand what you do well enough to give me the essence of what you do and how you take risk, I think you're either incredibly naive or you actually don't know.
Yep.
Both are bad. So the non-negotiable for me is if you cannot describe the essence of how you take risk. And you can hear threads of intelligence and thoughtfulness that make you want to dig deeper and help them do it. But when it's based in um, ego and a lack of self-awareness, it doesn't take a lot of work to know I don't want to work very hard on it.
Yeah. So what about traders out there that might know how to articulate what they're doing and they have a pretty good understanding, but they don't want to divulge or disclose as much because in their opinion, in their perspective, how they view things, it's proprietary, and they don't want to really divulge that. Like, what's your opinion about that? And have you overcome some initial early calls with some traders that might have not disclosed, but then ultimately they've opened up and been more sort of open?
Yeah, it's a really interesting dynamic because everything on both sides of the equation comes down to trust. And early on, I was talking to traders about the entire detail of their trading model, and most of them would talk at that level. Um, Today, I'm not spending as much time with individual trader. And you and John better be doing some of that. If somebody, yeah, like I keep using that word essence. I know what a proprietary question is, and I know what an essence question is, and I'll keep trying to make sure they understand that I don't care about book backs. I don't care about are you what type of volatility calculation are you using on your risk. Well, if I can't get them to understand, I'm not trying to pick apart specifics, and I really do want to understand the essence. I mean, at the end of the day, everything has really two attributes. You're either a buyer of strength or a seller of strength, and you've got some time frame that you operate in. There's a frequency that you trade. I mean, that's oversimplifying, but not a lot. What markets do you trade? Are you a trend follower, or a momentum trader, or a reversion trader? And in what time frame do you do it? If you can't give me the essence of that, that's not proprietary. That's portfolio risk. And as you know, when we're trying to build a portfolio, we've got to be able to put people into those boxes. One thing to look at the correlation of the return streams, but it's the other thing to know that those correlations make sense based on what they describe they do and how they take risks. The other thing too is it lets you gauge future trading to know if it's consistent with what they told you.
That's a good point. We had another interview. Again, I'm referencing the interview we had with John McCauley, who's trading coach for traders at Point 72. And when he talked about the traits of traders, he said, a lot of them are indeed self-aware. That's one of the qualities, but oftentimes they're also very much stubborn, stubborn in their focus and in their opinion. Like, how have you distinguished between someone who might be confident or stubborn and really believes in what they're doing versus overconfidence and egos? Like, where do you discern the difference of those traders that have been successful?
I mean, you know, I like to like a trader.
Yeah.
And it's probably a good idea for him. I mean, there is karma. If you don't like a guy that's trading for you, it's kind of hard to root for him, even though it's your money.
Yeah.
So, yeah, you're not going to love everybody and you're not going to be compatible with everybody. So there's a compatibility feature here. Stubborn's a good trait. Just like, somebody says, obsessiveness or OCD, it's a wonderful trait. It's fastidious, attention to detail are good traits, but they can be bothersome if you process it wrong. So it's really a lot of it comes down to personality. If I can't get somebody comfortable, I'm not asking a specific question or trying to reverse engineer, and I know I'm not. They don't believe me. I don't need to convince them that that's true. I can move on, have another conversation. So I don't. I'm not looking for everybody to like me, and I don't want traders that are all looking to be liked. But I do need to be able to communicate with somebody.
Yeah. That's good. That's good, Neil. One of the things that we look at for traders, and I know you've done, is this idea of their track record, but then also process. Like, do they have a process? How much weight early on, we're talking about the early allocation, do you place on a person's track record? Maybe you got lucky versus the process and how they think things through. What's the balance between?
Yeah. There's really steps forward to confidence in an allocation. I mean, first of all, if I can't, I would fund somebody without a track record, but it would be very unlikely. So, our initial screen, the thing that got us interested in FundSeeder, the reason we bought into FundSeeder was we had thousands of track records of real traders, and there was a high enough number of unique track records that randomness wouldn't explain. But I thought, okay, these are interesting track records. And then we talked to probably 20 of those managers. So at the end of the day, it starts with track record. A track record has to make some sense, and it has to make some sense in the context of the markets that they trade and the type of markets that you had in the time they were trading. And it's like a fixed income trader, short rates are long rates. When rates fell nonstop for 10 years and somebody made all their money trading bonds and short rates, it's unlikely there was as much skill in there as the numbers would suggest. So you look at the track record relative to the markets that produced it. That gives you an idea if you think you're interested. And then the next thing, and I've already said it, but is, can they describe the essence? Do they understand what their edge is? Do they understand what they're actually doing? Can they explain their risk? Can they do all that? It's not quite process yet, but that's the beginnings of a process. So you got a track record that makes sense, looks interesting relative to the markets that existed, and you've got a description from the trader on how he takes risk and what the essence of his trading is. You now have something you can say, okay, I believe that guy produced that track record in that marketplace, and I believe he might do that again. And process is really just a reenactment of that description he gave you. And does he do it the same way all the time? And, these are typically a lot of early traders, young traders. We'll see these guys go against their system. We'll see them not believing what they're doing. And you can see it in the trading. Then you question process. So to stay with somebody, they have to have a process. But a lot of times when you're starting out with a manager, the full process of understanding how trades are generated, how it feeds through your trade desk, what you do as far as reconciliation, the whole thing of running a business. A lot of that's not real well established when we fund. Uh,
Yeah.
but
Yeah, that's
it's
great.
got to evolve, or else
Yeah.
they're never going to run. They're never going to scale.
Yeah, and that's a good segue to the evolution, and really for the remaining part of this interview, we'll focus on, really what happens after a trader gets their first outside capital. I think what's unique about your background, Neil, is not only have you been an allocator, you've been a trader yourself, you've interacted with allocators, you've really sat in the seat of receiving capital. And I've experienced this myself, and I'm sure you have, when there's some psychological shift. I mean, it's one thing to manage your own money, and it's another thing to manage other people's money. So my question for you is, what changes psychologically for a trader the moment they receive outside capital?
If they have a real process, nothing changes. This is where process comes into play, and this is where you see the psychological battles you're talking about.
Yeah.
If going through that process and seeing how your mind changes doesn't force you into believing in the process and believing in your team and empowering people on your team, you're not going to scale your business. So the answer is, if you have a process, nothing changes.
Is there the human element? I mean, I know we've had some conversations, this year with some of our traders where maybe they had the process, but and it's their trading, but maybe they're not as disciplined enough, or maybe they're not maybe placing too much focus or impact on one, the allocators thinking for the fear of maybe having that account, being pulled. Like, are there any, I don't know.
By definition, if you don't have the discipline to follow a process, you don't have a process.
Yeah.
And yes, we have seen that with one or two of our traders, and it's a learning experience for both sides. How long does it take you to get them to admit that? It took longer than it should have in the case you're referring to, but he got there, which was a growing experience, which made us continue to believe that he may still be able to scale. It's not a straight line when you're allocating to new traders. I mean, there's a lot of learning. You may not have even understood how they took risk. I mean, you may have, I may have heard differently. You might get excited about a guy because he sounds high energy and smart and he's got a good track record. I may hear more positively in that case and not have listened as well as I should have. So, it's a process of learning. You don't just instantly do one interview, the guy starts trading for you, and now you know everything. You learn it as he trades. And, in any case where you thought somebody had a process and you say they lack the discipline to keep with it, then they don't have a process.
Yeah. And so that's, I think, a very good point for a lot of traders listening to this podcast that you mentioned, Neil. You might have an aspiration of managing outside capital, but before you even go to that uh, sort of that next step, because this is about, sort of the stepping stones of how you transition from just managing your money to managing outside capital, the process itself should not change. And in fact, allocators are looking for you to trade in effect the way you've traded, especially based on your track record. And
Which, by
so,
the way, it explains why higher turnover strategies and the trading in less liquid markets is massively problematic for considering consistent process and scalability issues because, liquidity. I mean, I've seen very experienced people that came out of large houses that did not understand the impact of their growth on the liquidity and their slippage. I mean, I've seen it with 3 or 4 very large traders that, learned that because it's so incremental. And I forget, I think it was Michael Marcus in an interview he did 40 years ago talked about slippage. He said, slippage is not a continuous function. It's a wall. You know, you don't just have slightly more incremental slippage. It all happens to you at once and your track record goes away before you blink because you've got more size than that market can handle. So shorter term strategies and things that trade less liquid markets by definition are less scalable and you better watch them more closely.
one of the topics that has come up in speaking with some of these traders that are part of this Rise Accelerator class is the topic about drawdowns. Where if a trader has been trading his own account and maybe they are comfortable with the larger drawdowns, but now they're looking to manage investor capital, where investors are obviously much more focused on limiting drawdowns. Is there, should the traders view things differently regarding drawdowns once they're managing outside investor capital? And should they adjust perhaps their leverage and be cognizant of it's a different portfolio?
Yeah, I mean, drawdowns are math. And if you hire a trader that has 35% annualized volatility and you're surprised he has a 50% drawdown, you're not a very smart allocator. So, typically it's if I have a highly concentrated trading style that requires lots of leverage and single instruments and my daily volatility is pretty high, you're going to have large drawdowns. So, if a large drawdown is a surprise, that means you didn't understand the risk that you started with, or things can happen in the market. You can have continuous types of markets that that pick on a particular frequency. We had an interesting market for most futures traders from call it post-COVID, 21 to 3, we had some of the most, call it unusual 19 to 24-day price movement where the markets were just continually trying to move out of a range and then falling back into it for almost 2 or 3 years. So if your models were highly dependent on that frequency, there's a good chance you had a larger drawdown than volatility or your track record would have suggested, of which we did. And we didn't understand what was happening to us at the time. And it was a risk that we had that we didn't understand. And that's why you're not finished learning in this business.
Yeah. I think one of the things that, there's that success story of that trader who had that big drawdown and you stayed with him during that drawdown because it was a grains market move where you were able to understand and analyze it and you were able to be loyal and actually stay with that trader because you understood that it wasn't, it was just an outlier sort of event. And I think that's pretty unique. I think that's a pretty unique from an allocator perspective to really have just the loyalty and the patience with some of these traders. From your side, what are ways that you discern the difference between, hey, this is a risk management failure, like you should have known better versus, okay, that was market noise and we still have confidence in you.
I don't know that I can give a generic answer. It's so unique. That situation was that you're describing. We had a grain trader that traded very large spread positions in global wheat markets. And when Ukraine happened and you had a complete destruction of the wheat market and specifically wheat spreads, and that was his entire book, there were two decisions. One, did he instantly become dumb? And I knew the answer was no. The
Mm,
bigger decision was with the book that we had on that he liquidated for all clients, was in the middle of liquidating for us. And I said, you can't liquidate. That was a ballsy call. In other words, I knew those spreads wouldn't be there in 6 months. I didn't know how much further they were going to go against us. And we had already funded a very large margin call. And I looked at it and said, if somebody had presented that opportunity to me, would have I entered it at that point? I would have. So that was as simple as I viewed it as, my weakness didn't make it a non-opportunity. Could have, but yeah, I was incredibly mentally weak. But at the end of the day, I asked myself, how would I interpret this if somebody brought it to me? I would have looked at it as an opportunity of a lifetime. And by the way, in 3 weeks, he made back most of the money.
well,
Uh, he's at new highs and he continues to trade for us.
well, in that moment of decision where you decided to make that move and obviously stay and not liquidate, was that based on your previous experience and maybe some of the mentorship lessons from the Druckenmillers of the world, or like how did you come to that decision and be able to make such a call when there was a lot of money on the line?
Yeah, I don't know if it's experience or blind view of value. I haven't I can't avoid a value. If something's cheap, I got to buy it. It's a character weakness, and that spread was so wide it couldn't sustain itself. Could it get wider for a day or two? Absolutely. But if I had to fund another 10 million of margin, yes, I could have.
Yeah,
But it became a completely separate decision.
yeah,
Staying with the man, it wasn't staying with the manager. It was literally saying, we're buying this position.
position. Yeah,
Yeah.
interesting. That's very
So that,
interesting.
that went from an allocation to a trade.
Yeah, yeah, that's interesting.
And it's interesting. Same thing in 87. When the market crashed in October of 87, uh, any CTA that was trading there can tell you every trend follower during the crash was so perfectly positioned. They were short bonds, they were short rate, um, uh, they were short stocks. And that morning, the bond market went from being down 3 or 4 to rallying 8 points over the next 2 days. I liquidated every CTA the day of the crash. And I remember some of them were really mad at me. 2 days later, they weren't. But we opened the accounts back up. But I told them they had to liquidate that morning. Uh, Great decision. And it was just it was exactly like that grain trade. It was to the point of complete unsustainability. And you might say, well, look at gold and silver today. Why not short gold and silver? Shorting is different than buying.
Yeah. Yeah.
Buying things that generally go up that are getting walloped is less dangerous than trying to fade a silver move right now.
A question that comes to mind, and I think you and I have chatted briefly about this, how important, I mean, I know it's important, but, and how does it, but maybe how does it get applied, this idea of mentorship for a lot of these traders that maybe they've learned to trade. I mean, these are the independent traders, the ones that have not started off on Wall Street. Maybe they got a Jack Schwager Market Wizards book. They've read some other books and they've done well, but they don't have, they're trading in a silo. They have maybe a Bloomberg turnable, but they don't have the mentors around them to say, hey, I remember this, or this is what I would do because I made that mistake. Like, number one, how is it I know it's important, but like how does it how does it functionally happen for these independent traders globally that might not have that network?
I mean, are you asking, can we do it and will they listen to us?
I mean, I think it's a big component. It wasn't necessarily. I think that's what we do, and that's what you've done in terms of some of these traders. You
Okay,
know,
I'll make it simple for you. You've got children. I've got children. Um, do you think what's the likelihood I'm going to tell my children something that's bad for them? Really low.
non-existent. Yeah,
What's the chances that they hear me criticizing them and it's not for their good? It's just because I'm criticizing. Very high.
yeah,
And that's just sort of human. And at the end of the day, these traders have to believe you're out for them. And if they believe that and they believe and you're careful with how you say what you say, you're not afraid to punch them in the nose and to say the truth, but you're also not careless in terms of criticizing in a way that they would take it personally. Um, Everybody needs that in their life, right? And hopefully we can be that for the traders to a degree so that they know we're being honest with them. We're not afraid to tell them the truth. And we have the experience to know what the truth is a little better than they do. And I'd say, generally speaking, I'm not saying we have that relationship with all the traders, but we do with a lot.
yeah. That's true, and I've seen many really appreciate it and open and welcome sort of that feedback, and because they feel like we're in the same, we're aligned in terms of interest.
Right.
Some red flags, perhaps, just from your background and in history that, as, sort of red flag behavior from a trader once they've received the funding and, kind of made you think, okay, and within the first months, like, let me keep an eye on him, or this is perhaps not what I thought, or I don't know if this is going to be a long-term relationship.
Yeah. I mean, again, if a trader does a trade that doesn't make sense relative to the risk they describe they take, the essence of how they trade, either he is, I'll use bad words, he's either a liar or else you're an idiot because you didn't listen well, one of the two. So, that's when you have a conversation. Say, what I understood is that, you would never fade uh, a market that's going crazy like this. And I don't understand how you're not participating in this trend move, given that that's one of the markets you trade and you're always trading every reversal, on a swing basis. Um, so missing a trade that you think they should have or doing a trade that you don't think they should have, red flag number one by a long way. And then you also have numbers. I mean, volatility spikes that are out of statistical expectations, drawdowns that are out of expectations, trading markets are not supposed to, trading size that they weren't supposed to. Those are all things that we monitor, sort of statistically, met with the computer. But and then how they react and respond to your question, and typically you didn't listen well enough or you didn't ask all the right questions. So you filled in a lot of blanks on how they take risks that you didn't understand. Um, the bigger red flags happen when a trader makes it. I mean, when you go from scraping by to running $100 million and collecting a $6 million incentive fee one quarter, I'm hoping you don't get a new wife. I'm hoping you don't get a Ferrari. That stuff happens.
Have you
And
seen that?
oh yes,
Yeah.
Those are red flags. And the other thing too is when they treat you differently. And again, you know, guys that we stood by through thick and thin that got so big for their britches they wouldn't even hardly talk to you.
Well,
In fact, I'd closed one account and um, wanted to open the account back up. We had a perpetuity agreement on fees with this trader. And when I actually saw him at a casino in Nassau, and we talked, and I said, I think I'd like to reallocate. He said, I'm full. I can't take your money. I said, that's
wow.
fine. I said, I've got a legal agreement that you will. And he said, it doesn't matter. Okay, now. Guess what? He came back 2 years after that and apologized and said he was wrong. He was a good guy, but he was very full of himself.
Yeah.
So you don't want to see people overly hard on themselves when it's bad, and you don't want to see people overly proud of themselves when it's good. That's life.
Yeah. Just that consistency. The
Yeah.
consistency of character, you're right, it is life. It's that, even going back to, self-awareness, and, in those moments. One more question and then just a kind of an ending point, Neil. Really, appreciate this. Um, there is idea of scale and your perspective of scalability in terms of giving capital to a trader. They've traded their own money. Now they get the first outside capital and now they have goals of scaling. Like, when do you see or feel comfortable that a trader can take on more capital? And like, what's your process from just increasing their capital over time?
I generally believe people can't handle near what they think. And 30 relationships in a drawdown is a whole lot harder than 3 relationships in a run up. And the pressures that come down on you as you add accounts in terms of for smart people second guessing what you do, the scalability of your mind to listen to other smart people tell you what you're doing makes sense or doesn't make sense is hard on people. So more relationships is is a manager's enemy. It's just hard to manage. And then it goes back to the earlier thing, higher turnover, you have more slippage as you try to scale, more illiquid markets. So it's really just it's talking to the manager and finding out where his pain points are and figuring out if he's handling it.
Yep. Last question. Um, Looking back at your career and more, not necessarily from the allocator perspective, but I'm just thinking back to when you launched with 75 million, and then, came back again
No,
had
we didn't launch with 75 million. We launched with 5 million and
5
grew to
million
7.
and you grew to 75 million. Um, what, what's the one sort of thing that you wish you would have known as an early stage manager who got their first allocation that you didn't know at that time? Of course, you've evolved, that you would want to like impart your wisdom to those who are or who are looking to follow in this allocation footsteps.
I made a major mistake not hiring more talent around me. I would have I hate overhead. Um, I would have found more capable people to do things that I couldn't do. Um, and StatArb is the better example. I mean, we grew that business to $2 billion, and I was kind of running everything. And to not invest in the business uh, and hire talent around me and take advantage of our success was a major mistake.
Good insight. Neil, really appreciate it. Thank you for joining and answering these questions and just for your wisdom for our audience. So thank you for coming on this call. Anything else you want to say or any parting words?
No, I just appreciate you taking the time with me. I'm a fairly private person. I don't do much of this, so it was fun to talk to you. Thanks for asking.
Thank you.
All right, see you, Emmanuel.
Bye. Thank you for joining us on the FundSeeder Rise Podcast, where we spotlight exceptional independent traders from around the world and explore the future of active money management. To learn more about FundSeeder, our mission, and how we support emerging managers globally, please visit us at fundseeder.com. The information shared in this episode is provided for educational and informational purposes only and should not be considered investment advice or an offer or solicitation to invest in any fund or trading program. Trading futures and other derivatives involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Until next time, stay curious, stay disciplined, and keep rising.